Hello, everybody. Luke Gromen, FFTT. Hope you are well and having a great week. It's been certainly an interesting, exciting, adventurous one with the election now in the rearview mirror. So let's jump right in. As always, thank you very much for the questions. Really appreciate them. I'm going to jump right in. First question is from KP. Luke, you get a few minutes to sit with President Trump, identify financial, economic issues, and provide your specific recommendations on how to address them. Go. I would sit down and I would say you need to devalue the dollar and or get US debt to GDP down significantly first, very fast, right away in the first 3 to 6 months of your administration, or else you will risk running into the worst economic downturn in decades. Turn yourself possibly into a Herbert Hoover in the history books if you try to cut spending or implement tariffs into debt that has not been reduced as a percent of GDP. You would then risk losing Congress in a landslide to the Democrats in 2026, and that would make you a lame duck president for the final 2 years of your final presidential term, and you would risk handicapping or kneecapping a presumed Vance 2028 presidential run before it even starts. There must be an order of operations to implementing tariffs, reshoring, cutting government spending. You have to get debt to GDP down first. I would equate it to being a debt restructuring. If you have a debt restructuring and too much debt and a 20-30% of your business is unprofitable sales, but you're barely covering your interest expense. That's how high your debt is. That's the case of the United States. If you cut the most unprofitable 20 or 30% of your sales, you need that cash flow. Forget about the profitability of it. You need that cash flow just to make sure you can service your debt. You cut those sales, you fire those sales, you cut those sales before you restructure your debt. Now you don't have the cash flow to cover your interest. You're done. Bankruptcy. Thank you for playing. However, if you do the same two things, you just do them in the opposite order. If you respect the order of operations, you go to your lenders, you restructure, you term out your debt, you reduce your interest rate. Now you have a much lower monthly net to cover. Now you can go to your unprofitable 20 or 30% of your sales, cut that part of your business, improve your profitability. Now you've improved profitability, and since you don't need the cash flow from those sales just to keep the lights on, you've restructured the business. Now the value of your business is going to rise, get stronger. You have to respect the order of operations. Same thing here. You got to get that to GDP from 125%, 120% down closer to 70 to 80% in a big hurry before you start cutting government jobs, spending, before you start implementing tariffs, etc. Because you're going to send the dollar up, and once the dollar goes up, with debt to GDP this high, we know how it goes. We saw 2022. We saw 3Q23. Dollar up, everything else down, wash, rinse, repeat until you get debt to GDP down, dollar down. So that's what I would tell them. From GF, hi Luke, happy subscriber here. Can you explain the dynamics of a gold revaluation, how that would work with buying treasuries with the proceeds? Wouldn't they have to keep buying gold in the open market to maintain the price and therefore borrow more? And additionally, on gold repricing, wouldn't the effect be similar to QE? In theory, yeah, it would essentially be like QE, except there wouldn't be a debt swap, as Bernanke, I believe, called it. It would be straight cash printing, creating money over the back of the gold, buying back treasuries with the dollars. So it would be straight money creation, much more inflationary. The way to do it mechanically is provided for in the Financial Accounting Manual for Federal Reserve Banks, Section 2.10. You can find it online. It's a public document. Treasury Secretary instructs Fed to revalue the gold every $4,000 per ounce in gold puts about $1 trillion into the Treasury general account, free and clear, straight money printing. Treasury Secretary can do whatever they want with it. If you do that, you can buy back Treasuries, reduce debt to GDP fast, per my prior point. You can use it to fund stimulus, reshoring, whatever. At any rate, I don't know if they'd have to keep buying gold in the open market. Number one, because I think every central bank in the world would be happy to follow the U.S. in doing this, because it would recap the Chinese consumer, for example. It would recap Chinese banks. It would recap the European balance sheet, create a bunch of money for them to do the industrial policy that Draghi has said they need. So I think you'd have a lot of central banks around the world go, me too, me too, me too. We're doing the same thing. We're creating money with it too. So number one, I think that would do the trick. They might ultimately have to maintain a market or bid for gold, but there's a couple ways you can do that. The first is again, all these countries have a printing press. So you can print money and buy gold. Like there's nothing mechanically stopping that. Maybe politically, maybe there's some esoteric central bank rules preventing that, IMF rules. I'm not sure. The other way you could do it is maintain a ratio in the gold oil ratio where you get some sort of international agreement where gold is now worth 100 to 400 barrels an ounce. And with oil production, if the major oil producers, OPEC, Russia, and the U.S. agree to it, there's your new market. That's your new market in gold. And then, okay, you based 100 to 400 barrels an ounce. I don't think oil is going to go down a whole lot because we need 65, 70 minimum to keep shale where it is. So that's another way you could do it. From BS, with all the recent U.S. administrative support for Bitcoin as a strategic holding and the concomitant price rise, do you expect gold to stay equal to Bitcoin in percentage rise in price, or will gold get left behind? Support or no support from the government, I would expect Bitcoin to rise versus gold over time on face-peeling volatility that needs to be accounted for by most investors on a position sizing basis. And that's precisely what's happened. If you call up a chart, this isn't speculative, you call up a chart, Bitcoin over gold, Bitcoin has crushed gold on face-peeling volatility. And so that makes sense. Bitcoin has a higher stock-to-flow ratio. It has an energy tie like gold does. And Bitcoin's got a growing network effect. So as long as that growing network effect continues, apps, etc., then I don't see any reason that would change regardless of whether administrative support continues or not. Let's see. Hi, Luke. Happy subscriber here. Thank you. How would Bitcoin higher price lead to more Tether and therefore more Treasury demand from Tether holdings? When Bitcoin goes up, it shouldn't mean more Tethers printed, or are Tethers printed and used to buy Bitcoin Treasuries at the same time. I would point you toward two things. Number one, U.S. Treasury report that came out 2 weeks ago, Supplemental Report 2 with the quarterly refunding announcement and Treasury Borrowing Advisory Committee report. It shows clear as day a positive correlation between Bitcoin's market cap, the number of stable coins out there, and the amount of stablecoin demand / holdings for U.S. Treasury T-bills. And so chicken and egg question, I don't know in terms of Tether, Bitcoin, what have you. I can show you clear as day. Bitcoin up, Tether up, T-bill holdings up. And so in theory, and not even in theory, we can point to the Treasury report talking about these kinds of things. We can point to Wall Street Journal op-ed from former vice presidential candidate Paul Ryan, who in, I think, June or July, highlighted that a source of demand for T-bills to finance U.S. deficits, which are problematic, could be stablecoins. And what do you need for stablecoins? You need more market cap in Bitcoin. So you could have a very, we've been kind of talking about this for a bit, but this virtuous cycle, the higher Bitcoin goes, it's not bad for the U.S., it's actually good for the U.S. It's inflationary, but look, inflation's in the cake at this point. That's, barring some miracle productivity solution, inflation's coming. We're just busy figuring out which inflationary solution we're going to get and how to keep the long end of the bond market from revolting once that solution is implemented. From Jesse, Are you still, quote, print to oblivion and onshore manufacturing to solve the interest expense issue? Uh, Ultimately, I guess in a nutshell, I wouldn't say print to oblivion. I would nuance it a bit to say, you tell me what the level of the dollar is, and I'll tell you what the level of the deficit is. DXY 107, U.S. deficit's probably going to be $2.5 trillion, and the U.S. has a fiscal problem now, today. You're going to have Treasury market dysfunction. You're going to have higher rates on weaker growth. Dixie 90, you're going to have $800 billion, trillion dollar deficits, I'm guessing, based on sort of the relationship. And 800 billion to a trillion dollar deficit, that's downright manageable. That's Dixie 90, given the current debt load and etc. Dixie 70 or 65, we could run a surplus like Clinton did. Now, what's the release valve? The release valve is inflation and the price level in this country. And then again, Dixie 70, you're going to need some measure of regulatory financial repression / yield curve control to keep bond yields below the rate of inflation implied by that soft of a dollar, because the US government cannot afford the 10-year going above 5% really. And you'd be talking about I don't know, Dixie 70, I guess you'd probably be seeing 8, 10, 12% CPI inflation. So you're going to have to repress the heck out of the long end. So that's how I would answer that. And that's it's really just, it's about the dollar. It's a level of the dollar. I would say the other thing is that without a productivity miracle, you're going to have to choose. You're going to have to either financially repress the bonds, or you can, if you want to stay with Dixie 107, you want a strong dollar, great. Then you're going to face a choice soon. Inject more dollar liquidity or go into a debt spiral like we started to see in 3Q23. Rates up, dollar up, everything else down. Wash, rinse, repeat until either tax receipts don't cover interest and then you default. Now, interestingly, that's why that deflationary path is only deflationary for a little bit. The dollar's a debt-backed currency. The fiat currencies are all debt-backed currencies. So if you get so deflationary, you get such a dollar super spike that the U.S. can't cover its receipts or can't cover its interest out of its receipts, then we face a print or default choice. It would never come to this, but let's run out the example. Print or default. Let's say they choose default. We want deflation. We want super spike. Okay, great. You default on the Treasuries, you're defaulting on the backing of the currency. The backing of the currency is defaulted on. Guess what happens to the value of the currency? It collapses. You're going to get, paradoxically, deflation drives hyperinflation in a debt-backed currency. That's really, right? So we're debating path. We're not debating outcome. Path is manageable and hedgeable by positioning. And as I said, they're never going to get to the point where it's default on treasuries and entitlements or print the money. The answer is always print the money. And it's all just a function of the dollar. So either way, managing for path, gold, Bitcoin, they win. Either way, barring a massive productivity miracle. And I think on some level, gold and Bitcoin this year, maybe they're starting to get it a little. Okay, from ST. Thoughts on what's driving this dollar strength, how long it could last, will it have legs or reverse? What's the interplay between US dollar versus EM equities and US dollar versus commodities? Thank you in advance. I think ultimately the threat of austerity or government spending cuts and or tariffs, they're all very dollar positive. This gets back to my point of the first question, where the order of operations must be respected. If you don't cut debt to GDP, you just start jacking the dollar up, you're going to break everything again. Dollar up, bonds down, stocks down, economy down. It's not going to be a great start to the second administration for Trump or anybody else. And it's going to be a real indictment of the policies, or certainly spun that way. We can be sure of that. So, what does that mean? It means right now, we've had a clear risk of a replay of 2022. If you like 2022, dollar up, everything else down, go to the beach until Yellen comes back in October to the IMF meeting in Washington and says, oh, the dollar at 114 is killing everybody. Okay, I'll start running down TGA. And then the dollar goes from 114 to, I don't know, whatever, 102, 104 in a brief period of time. And okay, great. But if you like 2022, you're going to love what comes next if the U.S. government does austerity and or tariffs without significantly reducing debt to GDP first. It's going to be 2022 on steroids in a compressed period of time. So, as I like to say, let's watch. Now, I will also add, I do think the dollar is going to be a lot lower than it is today in 6 months' time, 12 months' time. So let's watch. And the final question from WW. Do you think the following scenario provides an out for those attempting to de-dollarize but who want to avoid the credit contraction that would accompany defaulting on dollar-denominated contracts? It says, my contract says you have to pay me in dollars. No, you will accept yuan, gold, rubles. No default, no credit contraction. The short version is yes, and you know, this is exactly what China's been doing, right? So when you see China, the way things worked early on in the Chimerica economic system, right, was we ship our factories and jobs to them, they make the stuff, they send it to us, we send them dollars, they take the dollars and they buy treasury bonds and mortgage bonds and our stocks with the dollars. Then, after 2008, when the Chinese realized that those treasuries would not be made money good in oil terms, after we started doing QE, then they started saying, well, wait a second here. Why are we storing our surpluses in treasuries? Let's just go straight to the source. We're going to start buying oil fields, and we're going to buy copper mines, and we're going to buy gold mines, and we're going to buy ports, and we're going to buy all the stuff. And over time, we're going to change the invoicing on the margin to yuan. Paradoxically, what this does is it increases the supply of yuan in global markets where there's not much of a bid for yuan. There's not a lot of yuan denominated debt out there, and there sure as heck ain't no euro yuan market. And it reduces on the margin the supplies of dollars. And there's a $13 trillion offshore dollar denominated debt, big bid, constant bid. And there's a big euro dollar market, big bid. Big bid, big constant bid, slight reduction in supplies of the dollar. You're going to send the price of the dollar up. Now, that's a problem. If China in particular can only buy commodities in dollars, then what follows is China sees the price of commodities rise. They run out of dollars to buy commodities. They have to devalue the currency. They have a high inflation problem and currency crisis, a la late 1990s Southeast Asia. However, again, say what you will about the Chinese, they've handled this. They've played this marvelously, very elegantly, which is to say, when yuan falls against gold, if they can only buy oil in yuan and dollars, again, they have a Southeast Asia currency crisis, right? That tells you the yuan's falling. They're going to run out of dollars with which to buy oil, have a currency crisis once they run out of dollar reserves. However, when you spend 10, 15 years running around the world buying up the actual underlying, the oil fields, the copper mines, the gold mines, etc., with your dollars, and then have the ability to, on the margin, start to switch those into yuan. Now, when the price of gold goes up in yuan, but oil and copper and all these other commodities are priced in yuan as well, it sends a different message. It doesn't tell us, the price of gold going up in yuan no longer tells us yuan's collapsing. It tells us that gold buys more oil and copper and commodities in China than it does in London or in New York. And the gold starts to leave, goes to where it's treated best. That's what capital does. So, you start to see London gold vaults empty. Check. You start to see New York lose gold. It all goes east. Check, check, check. You start to see the Chinese set up yuan, offshore yuan clearing banks in every major gold trading or refining hub in the world. Switzerland, London, UAE, Singapore, of course, Hong Kong. Now, as China in particular, but in others, de-dollarize, move to yuan, you get the same effect. Dollar still goes up against the yuan. That part stays the same. What's different is that China can now buy commodities in their own currency, and they can't run out of that. And with the net gold settlement set up, what you see happen, there's two things. Number one, the price of gold goes up relative to all commodities. The gold to oil ratio and the gold to Goldman Sachs commodity index rises. Gold to oil ratio is up about 5x in the last 15 years, and gold to commodity ratio is up about 4.5x. Okay? What else happens? And why is that happening? That's because yuan balances are getting net settled in gold. BRICS local currency balances are getting settled in physical gold. And those imbalances are largely commodity driven. The other effect is that the stronger dollar, which always broke China and emerging markets before it broke the US and the Treasury market, now breaks the Treasury market first. It creates Treasury market dysfunction. It creates problems for banks that gobbled up Treasuries at all-time low yields in 2019, 20, and 21. Creates banking crises. It wasn't a banking crisis. It was Treasury dysfunction. It's a Treasury market problem. So now, this multi-currency commodity pricing, the way China has de-dollarized this, it's still deleveraging, but it forces a choice. It deleverages, it sends the dollar up, sure. But that dollar going up creates Treasury dysfunction. And that U.S. Treasury doesn't care. Fed doesn't care when U.S. debt to GDP is 125 or 25%, 30%, 50%, 60%, 70%. Doesn't matter. But when U.S. deficits secularly are $2 to $3 trillion, 7-8% of GDP, full employment, when debt to GDP is 125%, now the dollar going up beyond a certain point starts to break the Treasury market. And so that becomes the bottleneck. The bottleneck is no longer China's FX reserves. When do we run out of dollars to buy oil? The bottleneck has changed. The bottleneck since 2019 and certainly since 2020, 2022 has been, when does the dollar going up break the Treasury market? When does it create enough Treasury dysfunction that yields go up to the point where the U.S. government can't afford that interest rate because their debt's too high? And then the question becomes, will the U.S. government inject the dollar liquidity, which will send gold higher and weaken the dollar, all these things? Or will they stand aside and let the Treasury market defund entitlements, make them cut entitlement boomers into an already tenuous political situation in the U.S. and force the U.S. military to slash spending on defense? That's not happening, is it? So, that is, I have seen these arguments that, well, there's nothing the BRICS can do to de-dollarize. That's wrong. That's totally wrong. They're using gold to recycle surpluses into. They're using gold to de-dollarize. And ultimately, if the U.S. government is willing to stand aside and let yields go wherever they need to go, and let the Treasury market dysfunction, and let Treasury auctions fail, and still stand aside, and let banks fail, because their treasuries have fallen so far in price and that it triggers bank runs because depositors realize that there's a mismatch there, like you saw in Silicon Valley Bank, some of these other banks in 2023. Then, yes, if the U.S. government's willing to do all those things, if the Fed's willing to do that, if Treasury's willing to do that, then yes, absolutely. There's nothing the BRICS can do to de-dollarize. But you know, and I know, that's not going to be allowed to happen. That's never going to be allowed to happen. And so, there is something the BRICS can do, and the BRICS are doing to de-dollarize, which is multi-currency commodity pricing, net settlement in physical gold, priced in all currencies, floating in all currencies. And we're watching it happen. And it's not happening next week, next month. It is happening. Like I said, gold to oil is up 5x in 15 years. It's up 100% in just over 2 years. It's happening, but it's not happening all in this month like American traders want it to happen. But it's happening slow and steady. And at least when I was a kid, one of the books my folks would read me is The Turtle and the Hare, right? Slow and steady wins the race. So At any rate, I'm going to finish for tonight. Thank you for your time. As always, if you like these updates, check out FFTT-LLC.com for more information about our tree rings product, 10 most interesting things, brief synopsis about what grabbed our attention about them, and whether it's reinforcing or changing a way we had previously been thinking about the world. So, as always, have a great rest of your week. Look forward to chatting with you soon. Thank you.